1031 exchange rules in California. Special California 1031 rules and guidelines. The 1031 exchange rules in California are mostly the same as they are throughout the rest of the country. That's because it's a federal IRS policy that the 1031 exchange is based on, IRS Code Selection 1031. There are, however, a few points specific to doing a 1031 exchange in California that are very important to know if that's where you're considering doing an exchange. In this video, I'll explain how a 1031 exchange works and detail what those unique California 1031 exchange rules are, including what is a 1031 exchange, what are the benefits of a 1031 exchange, 1031 exchange rules in California, California clawback provision, and how to file a 1031 exchange on your California tax return. If you want to know all the 1031 rules in general, not specific to California, make sure to also read our ultimate guide to 1031 exchange rules. Click the link in the description for more information. First, let's talk about why you might consider using a 1031 exchange to trade property you or your client own in California in the first place. What is a 1031 exchange and its benefits? A 1031 exchange is also referred to as a like-kind exchange. That's because it's an exchange of two properties which are like-kind, which essentially just means that they're similar to each other in one or more ways. Why would you use a 1031 exchange then? The benefit of using a 1031 exchange to sell and purchase investment property is to defer capital gains tax. Think of it this way: you'll have to pay capital gains eventually, assuming you sell said property at some point down the line and within you or your client's lifetime. What if you could trade that property for another as many times as you'd like and still only have to pay capital gains on that one last final non-exchange sale? What could you do with that flexibility? The benefits for you and your clients are pretty diverse, much more than just deferring capital gains tax. For example, shift properties from one market to another more promising market, trade high maintenance properties to other lower maintenance ones, or exchange high risk properties for lower risk ones, or vice versa, depending on the market conditions. With that clear, let's break down the 1031 exchange rules in California. 1031 exchange rules in California. 1031 exchange rules have some unique quirks. For the most part, the only sticking point comes in when you're doing an exchange out of state. Whether that's for property outside of California for another within California, or for property within California for another outside California. Let's talk more about the California clawback provision later and why that is. Before I do that, let's go over what the 1031 exchange rules are for California. To do a 1031 exchange in California, it must be a business or investment property of equal or greater value and like kind. The buyer and seller of the two properties must be the same taxpayer, and you must complete the exchange within 1031 exchange timeline. Let's break down each 1031 exchange rule a bit so that they're crystal clear. Number 1, must be investment or business property. A 1031 exchange can only be done with business or investment property. The State of California Franchise Tax Board doesn't recognize recent 2017 federal tax code changes that made personal property completely ineligible for a 1031 exchange. There are some cases where personal property can be 1031 exchanged. However, it's important to talk to your tax professional to make sure you're taking the right steps to avoid any issues down the line, if that's the case. If a mistake is made, the exchange could be considered invalid and you'll be on the hook for the capital gains tax after the sale. Number 2, both properties must be of equal or greater value to qualify for 100% tax deferment. The net market value of the exchange property you're purchasing can't be of a lesser value compared to the relinquished property you've sold. Let's look at some examples. This example qualifies for 100% deferment. Relinquished sold property, $1,250,000. Exchange purchase property, $1,400,000. Well, this one doesn't qualify because the exchange property is of a lower value. Relinquished sold property, $1,250,000. Exchange purchase property, $1,200,000. One more important note, this doesn't just apply to the net market value, but to the mortgages as well. Both the net market value and the mortgage on the replacement property must be of equal or greater value compared to the relinquished property. So for example, this exchange would qualify for 100% tax deferment based on the net market value. Relinquished sold property, net market value, $1,250,000. Exchange purchase property, net market value, $1,400,000. But if this is the balance on the mortgages, it's invalid because the mortgage of the new property is less than the balance of the mortgage of the relinquished property. Relinquished sold property mortgage, $650,000. Exchange purchase property mortgage, $515,000. What if the value of the replacement property less than the relinquished property? If the value of the replacement property is less than the value of the relinquished property, you'll pay the boot or the difference in the value between the two properties. In other words, immediately upon close, you'll be responsible for paying capital gains tax on that difference. In this example, you'd pay capital gains tax on the $50,000 difference. Relinquished property, the one you're selling, value, $975,000. Replacement property, the one you're buying, value $925,000. While the remaining $925,000 will be tax deferred under the 1031 exchange policy. Number 3, must be like kind. This one sounds confusing and potentially restricting, but it's generally not. According to the IRS, like-kind property is one of the same nature or character, even if they differ in grade or quality. That generally means both properties must be used for a similar purpose, and that includes a wide variety of purposes. Even something as simple as both properties being commercial can fly, so it's pretty flexible and generally nothing to worry about. Number 4, must be the same taxpayer for both properties. This is one of the more straightforward 1031 exchange rules. This rule states that both the seller of the relinquished property and the buyer of the replacement property must be the same party or individual. A 1031 exchange can't be performed by multiple parties in an effort to avoid a potential loophole to transfer properties between properties during an exchange. Must complete the exchange within the 1031 exchange timeline. A 1031 exchange must be completed within a 180-day period. This starts from the date of the sale of the relinquished property. If the exchange isn't completed within that time frame, it's considered invalid. There are other important details to the 1031 exchange timeline though. First, you need to hire a qualified intermediary to manage the exchange. This should happen as soon as you set up a contract with your broker or realtor. Next, you need to select 3 exchange candidates. By the 45-day mark, one of these 3 properties must be the property you finally select as replacement property. You need to purchase it by the 180-day mark. Once you've purchased the replacement property, your qualified intermediary releasing the original relinquished property sale funds for the purchase. The exchange is complete. California clawback provision. No, the clawback provision isn't about defending yourself against California mountain lions. The California clawback provision is an important part of doing the 1031 exchange in California. Not fully understanding the provision can lead to unnecessary double taxation down the road, so it's a biggie. The California clawback provision per FTB publication 1100 IREV 2007 selection F states, capital gains incurred by California property are subject to California state tax. In other words, California property sold in a 1031 exchange and replaced with an out-of-state property must pay capital gains on the final sale of the property. Sounds pretty harmless, right? After all, that's how a 1031 exchange works. The problem is that California applies this rule even after you've exchanged the California property for a property out of state. California clawback provision example. Let's look at an example to illustrate where the issues arise. Let's say you exchange a client's property in California for another in Nevada. The California property was worth $100,000 when you purchased it, but now appreciated to $250,000. You defer taxation with the exchange and go on your merry way. Years later, you sell that Nevada property. The previous $250,000 value has now appreciated to $350,000. You won't just pay capital gains tax on the $100,000 $100,000 capital gains on the Nevada property, with the clawback provision, you'll also pay California tax on the $150,000 gains from the original California property you exchanged. One way to get around this is to exchange for a property in California before the ultimate sale, in which case you'll only be subject to California state taxes if the ultimate sale occurs in California. Annual information return for former California property. California requires you to file an annual information return if you exchange California property for non-California property every single year that you own the property. According to a recent update by the California State Franchise Tax Board, like-kind exchanges for taxable years beginning on or after January 1st, 2014 require California resident and non-resident taxpayers who defer gain on the sale or exchange of California property for out-of-state replacement property under Internal Revenue Code Selection IRC 1031 to file an annual information return with the Franchise Tax Board. Taxpayers are required to file an information return for the taxable year of the exchange and in each subsequent tax year in which the gain or loss attributable to the exchange has not been recognized. If a taxpayer fails to file the required information return, the FTB can estimate the net income from any available information, including the amount of gain deferred, and propose to assess the amount of tax interest and penalties due. However, so long as you continue to exchange or never sell the property and submit the annual return, you won't be charged taxes. How to file a 1031 exchange on your California tax return. Filing a 1031 exchange on your California tax return is pretty straightforward. If you perform a like-kind exchange of California property, you must report that exchange on a FTB Form 3840, provided you do both. Perform a 1031 exchange for property outside of California and defer gain or loss under IRC 1031. FTB 3840 must be filed in the year of the exchange. It also has to be filed every year after that until one of the following. You pay California state taxes on the deferred gain or loss. You exchange the new out-of-state replacement property with another out-of-state property in a 1031 exchange. The owner of the replacement property dies, or the property is donated to a nonprofit organization. Stay informed. IRS and California state-specific policies are changing all the time, often every few years. Make sure to keep yourself informed, or at least brush up on the latest amendments. That way you can not only reduce the chance of issues arising, but make the most of the exchange. If you want to learn more, check out our master guide, IRS 1031 Exchange Rules, Requirements, Timeline, and Guidelines in the link in the description. Thank you for watching this video. Please like, comment, and subscribe for more property management content. Also, check these videos out. Thank you, and have a great day.